Hi guys, I'm a Forester here, and I want to make an update on financial investing in retirement. So I've been retired for 2 months, and in those 2 months I've been able to spend more time more actively managing my investment funds. So I have 3 investment funds that I manage. 2 are tied to prior employers. They're pre-tax money. And so those are in index funds, and they're pretty much on autopilot. I don't do much with them. I can talk about this in more detail if there's any demand for it. The one that I more actively manage is my Schwab account, and that is one that I buy individual stocks. So I enjoy stock picking. I've done that since the 1970s. I'm fairly comfortable with it. And so back then, as I recall, I had to pick up the phone and call my broker to get stock prices when I was considering making a purchase. But I was watching a video just recently, about 2 weeks ago, and there was a fella talking about, he was comparing Vanguard to Fidelity to Schwab. And by the way, he ranked Fidelity number 1, Schwab number 2, and Vanguard number 3 in his comparison. Well, I used 2 of those, Fidelity and Schwab, plus one other. And I was particularly interested in his comments on Schwab because he had one major negative that he had to say about Schwab, and it's their cash account. So when I'm waiting to make a purchase on Schwab, maybe I'm researching a stock, I keep the funds, the available funds in this cash account. I think they call it a sweeps account. And it pays a very, very, very low interest rate, much lower than, he said, Fidelity or Vanguard. And so I knew I was sacrificing interest, but I did that for one reason, so the funds would be readily available. So here's tip number 1. The guy making that video said he had a better solution than keeping money earning almost no interest in that Schwab account. So his solution was to invest the money into SGOV, so it's called SGOV, ETF funds. And so I did that. I gave it just a little bit of research. Usually I have to think about something long and hard before I make a decision, but this seemed to be a no-brainer. So tip number 1 is, if you're with Schwab and you're keeping your cash available in that sweeps account, look up SGOV, research it yourself, read about it. They invest in short-term T-bills. And so it's readily available. I switched the money over to it, and I've already received one of the monthly dividend checks. It was, I think, around $500. And I'll just let you know, I don't mind saying, in 1 year's time, that simple decision is going to mean over $6,000 to me. So, and it's readily available. So when I've already made a purchase, and I was able to cash out that enough money from SGOV immediately to then put over into a stock trade. So if you're with Schwab, really give that some consideration. Tip 1, remember SGOV. Okay, tip 2 is a little more complicated, and it's not something new to me, although I didn't really understand it, but it's options, selling options on stocks instead of selling stocks directly. So my thinking has always been, I didn't really fully understand, and I still don't, the options business. But there are plenty of videos out there talking about options, so look it up and research it yourself. This is one you need to give a lot of thought to. But I had always heard about options, and I was interested in finding out more. Now, one advantage of Schwab is that they have local offices, and I have an office within 2 miles of my home. So I went over and talked to the office manager, to the broker there, and he told me a lot about it and demonstrated it, so that gave me a little bit of comfort. You have to actually apply for permission to sell options with Schwab. I did that. I filled out their form, and within, I'll say, a week, I was approved. So the way I'll just briefly explain options, and I only do one form of options trading, and that's covered calls. It's the least risky form of options trading that there is. With covered calls, you already own the stock. So you have the stock. You're not gambling on what the stock price is going to do necessarily. You own the stock. And so I'm going to give you two examples that I've done. I did them on the same day. I did both of these on August the 26th. I'm going to give you the amounts that I bought, the prices that I paid, and the strike prices and the term, the length of time that that is tied to that stock trade. So the very first one that I did was with, and by the way, so I used two, because I'm not familiar with options trading that much, I used two totally different strategies. So within tip 2, there's going to be two strategies. Okay, the first strategy I used was with a stock that I already owned. In fact, I have owned it for decades. Jack Welch was the CEO of GE when I bought this stock, and they've had a number of at least two CEOs since then. So you have rule number 1, you have to have 100 shares of a stock to sell one contract. So one contract is 100 shares. And you have to set a strike price. That's the price that you agree to sell the stock at if it reaches that price. They pay you for that contract. So you receive the payment for the contract the day that this contract is signed. You also have to determine the length of time you want to give them, the person who purchases the contract, for it to reach that strike price. So this will become a little clearer as I go through the examples. So the very first option covered call that I made was with a stock that I owned. I've owned it forever, and I paid $188.91 for it back when I bought it. So on 8/26, I sold one contract for $310, and it has to reach that price by October the 17th. So $310 strike price by October the 17th. Now here is my strategy. I do not want to sell GE. The GE has been on a tear. Ever since GE split up into 3 companies, 2 of those 3 companies, GE and GE Vernova, have both been on a tear. They've been some of my best stock investments. I don't want to sell it for one reason. I don't mind claiming a profit every once in a while, but I get eaten alive on taxes. And last year in particular, I had to write a very large check to Uncle Sam because of some stock sales that I made where I had a good bit of profit that I was cashing in. So I don't want to do that 3 years in a row where I have to write Uncle Sam a check for $20,000 or $30,000 at the end of the year. I had decided that I was not going to sell any stock in 2025 just to avoid having to write a check like that to Uncle Sam again 3 years in a row. So at the time when I sold this stock, it was at $279. No, I'm sorry, that's what it is right now. I forgot to write down what it was whenever I wrote the contract. But anyway, right now it's $279. I think it was at $268 or $269 when I actually, the day I sold this contract. But I sold the contract for $113. That was deposited into my Schwab account the day that on the 26th, August the 26th. And the strike price I chose was high enough that I did not think it would reach it by October the 17th. So I chose a very high, what I consider to be a high strike price, hoping that it would not reach that and I would not sell the stock. The contract would not go through. If it does, so right now it's $279 per share. If it did go to $310, that would be an 11% increase from now. and it's been going up ever since this contract was signed. So you can see $113 is what I made. If I sold it at $310, well, that's a good bit higher than it was when this contract was signed. So that would be an additional profit. I'd be happy with it. So, but I hope it doesn't go through. If it doesn't go through, I'll do this all over again. So I'll do it repeatedly, setting a price that I hope it doesn't reach, and do that. I could do that every, say, 2 months or so. All right, so that's strategy one, a stock I already owned that I want to keep and don't want it to sell, so I set a high strike price. Here's option two, and this is a little more creative. It involves Kroger. Okay, so I invested in Kroger. I bought Kroger stock years and years ago, in fact decades ago, and I held it for probably 10 to 15 years. Finally sold it for a profit because I didn't know how much longer it was going to go up. I was sort of tired of owning it. It wasn't a very volatile stock, but it finally, I think, more than doubled in price, and I sold it. Since then, I've bought and sold it on a swing trade type basis, buy it low and 2 weeks later sell it a little bit higher. So I have experience following Kroger stock, and that's one key to what I do is I follow stocks closely, maybe only 12 to 15 stocks, but I try to follow them fairly closely. So with Kroger, on that same day, 8/26, I bought 300 shares. Now to do a covered call, remember you have to own the stock. So I bought 300 shares of Kroger stock for $68.96. And I immediately, so that trade went through immediately, and I immediately then sold a contract for those same 300 shares. I raised the price $1. Now my strategy here was I don't want to keep the Kroger stock long term. I didn't mind if it sold that same day. I increased the price $1, so I asked $70. That was the strike price. I paid $68.96. I raised it $1 to $70, and gave them until September the 12th. Now this is the 7th right now, and so by Friday, you can follow this with me. By Friday, if Kroger reaches $70, it will sell, and I'll make $1 per share, 300 shares, so I'll make $300 on the stock. But get this, the covered contract, the covered call paid me $480 back on 8/26. So the day that this went through, I was paid $480, and I'll make another $300 if it goes through, if it sells, if it reaches 70. I want it to reach 70. I want it to go through. If it doesn't reach 70, which right now it's not at 70, I forgot to write down what the current price is, but right now it's not at 70. If it does go to 70, then this sale will go through. Or if it doesn't go to 70, I'll just do this over again, and it'll be another $480 or $500. So just with those two deals, I made $593 already, and then more will come when those sales go through. It's very low risk. You know, I'm not experienced at it, and that's why I've tried two different strategies just to see how it goes, but I feel good about both of these. Neither one has gone through yet, so I still own the GE and I still own the Kroger. Hopefully the Kroger will be gone by the end of this week. All right, well, those are two tips, and like I say, I'm not a pro at investing, and so don't take my word for it. Watch other videos of people who are pros, and you know, but with a little bit of attention, a little bit of research, you can increase the return on your investing. The best example, the best tip of these that I've given you, and the easiest one to do, is take that money out of the sweeps account if you're with Schwab and buy some SGov. Y'all take care. I hope you found this useful.